Well, good morning, everybody. Welcome to day 2 of the Professional Trader Advanced course. We looked a little bit at the market this morning. We saw that we had some very good economic indication. The market did gap up, but immediately they started taking profits out of it. Before we get into the actual market itself, let's jump right back into the lecture series and get some of our technical analysis done. This way, when we start to trade this afternoon, you'll have some more tools to work with. So with that being said, let's move ahead. Now, yesterday we talked a lot about support lines and resistance lines, trend lines, and we got a little bit into moving averages. Here today, we're going to start off with patterns that say the trend should continue. But as I always want to tell you guys over and over and over again, nothing works 100%. All ready? Now we're going to start off with the first one, which is called a symmetrical triangle. Now, a symmetrical triangle is either bullish or bearish only by context. So here we see on 528 and 529, the stock has gapped down, and we have about 4 or 5 points of contact that create our right-hand side symmetrical triangle. Therefore, we're going to expect the thing to break down to the downside. It's a consolidation pattern that shows the price becoming narrower and narrower and narrower, okay? Now, the only reason we call this one a bearish one is because of the gap down. It's already in a declining pattern, if you will, because of the gap down. Now, there's a couple of interesting things on triangles. We need at least 4 points of contact. Up here you can see the number 1, number 2, number 3, and number 4, okay? The legs themselves actually give us some idea of what's going to happen here. If you'll notice that the top leg of the triangle is much longer than the bottom. This is what we call our zero line. Let me put this up on the board for you. So, effectively what we see is a situation like this where the bottom leg is actually shorter. Okay? This will give us a little bit of a timing tool as a measuring object. If we were to look at this distance from the zero to the apex, we would expect the breakdown to occur at about 38% back. Again, one of those Fibonacci numbers. Or we could say 61% from the beginning of the short line. Either way, 61.2 or, okay. So if we saw the thing zigzagging in here, this is the area, the timing area that we would expect the thing to break down. About 1/3 to 40% back, somewhere in there. Now, as you guys can see on this particular slide, if you were to take the horizontal axis out through here, the thing really breaks late. It's a little more than 1/3, 2/3 forward. But you can see that the original try right here was just about at the perfect spot. Okay? Okay, the next one we have is the ascending triangle. Oh, excuse me. We just looked at a symmetrical bearish triangle. Can we have symmetricals in uptrends and therefore symmetrical bullish? Sure. Absolutely, okay? Now, the next guys have either flat tops or flat bottoms. This is the ascending triangle over here. And again, it's a continuation pattern for an uptrend. Now, this one is bullish by its very nature. We can see that, yes, it's in the context of a short uptrend here. But more importantly, what's happening is that as time goes by, the buyers keep selling it up to the same level, but the sellers cannot push it down as far. So the buyers are effectively squeezing the sellers into a corner where either they're going to have to hold or they're going to have to yield, one of the two. And of course, what we're expecting is that they'll yield and the buyers will win and break through the flat top resistance line. Okay? And we can see that happen here. Again, if you look at the slide, you can see that the top line is a hair shorter than the bottom line, the angled one, and therefore this would be our zero line. Again, we would be looking for about 38% back from the apex on the shorter as the anticipation breakout area or time zone. And again, this one does a very remarkable job on it. Okay? They're not always this good. Again, the most important thing here is what? We got into this, into the trade for some reason. And all of a sudden, the thing starts to go sideways and starts hitting resistance. Do we want to take the position off? Or do we have some sort of probability that this thing isn't over yet? And that's what continuation patterns are all about. They're supposed to keep you warm and fuzzy while you're in the trade. Now, obviously, if we saw it break down below here to the downside, it would fail the pattern and therefore start giving us indications we should take our money off the table. Alrighty? So, of course, you can see that it does react very well, and we hung in there and we made a gazillion dollars. Yay, team. Okay? Now, of course, we can have the opposite, a descending triangle, and again, by its very nature, it's bearish. This one also happens to be in the context of a downtrend, and this one's on a daily chart now. And we can see that we have a series of lower highs. But over here in February, we form a little bit of a double bottom, and we get a little bit of a bounce up, but then we have a declining series of lower highs. Again, what's happening? The buyers are trying to take it up, but the sellers keep squishing it down lower and lower and lower until finally they force the buyers to hold or to cut and run. And again, they cut and run. Now, if you look again, this would be our zero line here. The top one is the shorter one. And I don't know, maybe that's 33% back. Maybe it's 26% back. But it breaks back significantly from the apex. Where would we start to anticipate? Well, once again, we might actually want to get out here and measure this distance, work it out exactly to 38.2, and have our finger on the trigger. Now, this is a daily chart, so we're going to have a whole day to make that decision, okay? And if it's going up, I doubt that it's going to be breaking down. So we just have to wait for it to approach the bottom, get ready. If not, we wait for it to approach the bottom and get ready, okay? We also have a measuring object of a different sort in here, okay? The vertical distance from the short line to the bigger line, again our zero line, is generally the expected fall after the breakdown. So if we looked in here and said, well, we're roughly at 2250 by 3250, well, that's a $10 move, okay? So when it breaks down, we can expect it to go from 2250 down to 1250 before it finds support. And that's about right where this red candle is. As you can see, it actually goes down lower to the $9.68 area down in this neck of the woods. But again, if I saw this and I was trying to get short here, would I be pretty happy? Sure. I know I've got, 10, 12 bucks worth of play in this. Here's our pioneers right here, okay? A whole day of them. They opened it up, they moved it up. The sellers took it all the way down. The buyers came in here just knowing they had found the bottom, and the next day they got hammered. Okay? Again, pioneers with a real tight haircut and a couple of arrows, okay? Okay, now we start getting into a few of the more esoteric type patterns, continuation patterns. And the first one we have up here is a bullish flag, okay? The bullish flag is, again, a consolidation, a slight retracement after a really good run-up, alrighty? And we can see that over the course of a couple of hours, we've had a nice loopy up, and then the thing takes off and creates some very long stretched, in this case, green candles. These two green candles here form the pole, alrighty? And then the flag kind of drapes back down. Now, the interesting thing is if you really look at this carefully, you'll see that the shadow on this candle over here to the left goes way down to about, $32 down here at the bottom and still incorporates the retracement. So even though this price looks like it's coming down back, it really hasn't made a lower price. Alrighty? It then breaks out to the high side and the next day fails, but at least it did break up according to Hoyle, if you will. Because again, it's a bullish flag, so this consolidation, when it's over, we expect the trend to continue up, at least for a period of time. How long? Boy, I have to get my crystal ball out and have that one checked. Alrighty. Again, and why do we call it a flag? Well, because it's square on the end and it kind of drapes down, just like you see a big flag hanging. Now, here's the opposite here. We got a bearish flag. And again, we have the overall context of a downtrend, but you can see the very, very exotic shot down that forms the pole. Okay? Real long stretched red candle, and therefore a retracement up. Again, what we're going to be expecting is what? A continuation, a break back down, and sure enough, the thing continues on. Now, it doesn't take much imagination, but can you guys all see my downtrend line, that if I were just to extend it, that would also hold me in? Okay? So, again, what's the continuation pattern here doing? It's trying to give us a little bit more credibility. But if we got short anywhere along the downtrend line, and we were using our downtrend line as our rule, and just said, if we get a close above that line, we're out, well, then we would still be in. But this would kind of scare us a little bit because it got so steep. So being able to see this may help you just say, oh, well, my rule's good. I'm going to leave it alone. I'm not going to mess with it. Now, if a flag is square on the end, we also have pennants, okay? And in pennants, of course, are triangular little flags. And for it to be a flag, it's got to have a pole. Again, over here, we have the bull pennant on the left-hand side. We can see where price came down, consolidated, and then sharply broke up in two basic big legs right in here. One and then two. And then we get a symmetrical triangle, which is all it is, but with a pole. And therefore, again, because it's a continuation pattern, we expect it to break to the upside. Well, does it? Yes. Was it? Did we hang on to it overnight? Gosh, let's hope not. Okay? Because they don't always work. I mean, this one actually worked, but it was so short-lived that you couldn't take much advantage of it. It did pop out to the upside, but the next day, boom, brought it right back down into the same prices at around the $37 area that we had been seeing prior to that. So this was just a very volatile day on the 23rd in here with a pop-up, and then the thing got back to normal, dropped down, and ran sideways. Okay. Questions so far?
Would that, the next day, would that be a bearish flag?
We could have a little bit of a bearish flag right in here, yes. The pole, okay, again, guys, a symmetrical triangle, and by the way, when I say symmetrical, it doesn't have to be isosceles. I mean, it doesn't have to be perfect, okay? But if we just saw price moving up, here we have a symmetrical triangle, okay? But if we saw a price doing this, now it's a pennant because it has a very stretchy pole on it, okay? And that's the only difference. It's just that after a very exciting rally, we got a symmetrical triangle, or after a normal trend up, we got a symmetrical triangle. This one's called a pennant because it has a flagpole on the end of it. This one does not. You just got a trend line on it. Okay? Alrighty. Now here is a bear pennant. Now this one's a little harder to see, guys. And of course I set down my laser pointer again. This one's a little harder to see because Thomas just asked, well, what is the difference between a pennant and a symmetrical triangle? Where's the pole? Well, the pole is the uninterrupted red down here. There's absolutely it's not a vertical pole, but because it's just such a big sell-off here, zoom down, they would say that that is the pole. And again, Beauty is in the eye of the beholder. We're talking art here, okay? So you can't say, oh, well, Mike, that pole is broken, it's leaning over, okay? Alrighty. Did I say these were a little more esoteric? Alrighty. So, again, you can see, though, guys, that if I picked up this point up here and this point and created a downtrend in the stock, is this going to make me too nervous? If I got short up in this neck of the woods, it's going to come back up. My rule is what? A close above that red angled downtrend line is my out. Now, I'm not trying to belittle bear pennants here, okay? But if I go with simple trend line trading, I don't have to worry about this as much, okay? Because I expect the thing to break down, but of course I expect it to stay underneath my trend line as well. And my rule is very simple. When I get a close above my trend line, I am out. So I'm still in on this trade because I don't have a close. That's an open above that trend line. Okay, it's a red candle. So I'm still in this trade, if I will. So whether I had the continuation pattern to keep me warm and fuzzy or I had my trend line to keep me warm and fuzzy, both work. It's just, how do you like to look at it? See, if you're, how shall I say it? If you're kind of a laid-back trader, already, you're going to put a trend line on there and you're going to watch it. But if you're a busy trader, you're going to want to draw little things in here to keep you busy. Ready? But they're both telling you the same thing, aren't they? Stay short. Now, here is a bearish wedge or an asymmetrical triangle. And the reason we call it asymmetrical, and again, Thomas, we can talk about this, is because it is pointed not horizontally. It's either pointed up or down. Again, this one is bearish because the thing is in an overall decline here. But isn't this a pennant? Isn't that a pole right there? Sure, okay. Now you can see that we also have a very large overall descending triangle. We've got some tops over in here and here and here, okay, which eventually becomes support over here and here. And we've got a declining series of lower highs. So we have a declining triangle, which does break down, which creates the beginning of the, if you will, the pole for the bearish wedge. And then the bearish wedge breaks down further. Okay, so we have a series of things here telling us. Again, could I simply describe a downtrend line and still be short in this trade? Absolutely, okay? Again, what do you need in order to help you stay in or get out of the trade? What do you need for the protection of your capitalization and the hopeful advancement of such? Yeah.
You say you're watching this over the whole period of time, where would you be getting in and getting out, and how would you want to trade it?
Well, okay, we're looking at a 3-day, 5-minute chart, already. The first thing we do note is that in the 24th, okay, we do have a series of lower highs. And any touch of this line would be a sell signal with the ultimate goal of the first support line. Okay, so to answer your question, if I pick up the top here and the top here, I could get short on this candle right in this area. Okay, I would stay short and stay short, and I would think about taking some profit off as I approached my support line. We sold near resistance, we'd want to buy near support. Okay, now how much? If the thing is really looking weak, then maybe I only want to take 50% off and see if the declining, descending triangle will make it break down. Now, I still don't get a close above the line here, although this coming back up is making me nervous. But the descending triangle is forcing those buyers into a corner, okay? And they eventually do break it down. Boom. Now, if I took this home overnight, I'm a hero. Alrighty? Now, we took it home overnight. We're heroes. Very little gap fill in this thing. And the thing starts to come back up. Where are we going to take profit? Alrighty? Well, The first thing, of course, is if I got above my angled down line, I would be under rule constrained to get out. Okay? And if I went straight up and hit my horizontal resistance line, I would also be somewhat constrained to get out. But I have a bearish wedge in here, so I'm looking for the thing to break down further, and the moment it breaks down, I may add to my position. Now then, where would I go to take off profit? Well, we don't have enough information to really do it perfect, but can everybody see that the low over here from the 23rd, which is around $57, $58, if we bring that right across, guess where it finds support? So again, if I took off 50% here and I left the other 50% ride, and I see this low over here, well, that might be time to say, Mike, you've been in this trade for 2 days, you've made a heck of a lot of money, take it all off, and let's see what happens. Because right now, the thing is just going sideways, okay? And if we have another continuation pattern forming, maybe we got a little triangle right in here, and we expect it to break down further, we could get back in, okay, upon breakdown, upon fulfillment. So, and again, this is a 5-minute, 3-day. Could this be a 1-minute intraday? Could it be a daily chart? Yeah. You know, the same rules apply. So here's multiple patterns, okay. Again, we see we have a little bit of an uptrend, and we got the exotic stretch of the green candles creating the pole of our bullish flag. The thing breaks out to the upside, forms a symmetrical triangle. Again, we're in an uptrend, so we expect a breakout. It does. It's short-lived, but it does break out to the upside. The thing rolls over, falls down, and starts forming a descending triangle, a declining triangle, if you will, okay? Again, here's where we might note our measuring object. On the shorter of the two lines, we put a vertical red arrow in here, okay? And where the thing breaks down, we expect it to fall that far, okay? Now, this one did not break down 38% back from the apex. It broke down virtually right at the apex, okay? But again, you can see that, these two red arrows here are basically the same size, and that's about the same length of the fall there. It's interesting how this stuff works out, okay? Some of it can be explained, some of it cannot be. It's just human habits and the way people see things that cause them to do things. And it's amazing how many react the same way. What was it Carl Sagan said? We're all star stuff. Alrighty. Now, another continuation pattern is the cup and handle. Now, the cup and handle forms a U-shaped bottom. And if you look at ours up here, you can see that our cup has a pretty good crack in it, right in this neck of the woods. You ready? But we usually see a little bit of a smoother, more symmetrical bottom down in here. The thing has come up, it's hit resistance. We've got a little double top over here in the middle of July, end of July and early August. The thing sells off, it comes back up and hits that same resistance line. It has a very small retracement, less than 38.2%. So this is forming the cup, and this is the handle in here. We are now looking for a strong buy signal. The buy signal will be a break and a retest of the line, top line of the cup. So we see the handle come up, we're anticipating, it sits back down on it, and as soon as it starts to move up, we could buy it here, or we could buy it over here, okay? Again, we can start to describe an uptrend line by looking at these lows through here and here, and again, we'd be able to buy any of these retests of the line because we're allowed to buy near support, okay? Anybody see a timing pattern in there? Zoom, 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 zoom. Bet you if I put a line on it, it's real close to the same thing. You ready? Again, you have to start looking for these things, looking for patterns within patterns. like we did the other day with that, what was that, 30-minute line. Okay, this might be a 1 month line, it looks like. Okay, but it looks like there's a cycle in that stock, and a little bit of an investigation might prove that out. Okay, so again, the cup and handle is a continuation pattern. We've had an uptrend. The thing comes up, does its little thing, and as soon as it breaks above resistance, which now becomes support, we are allowed to buy anywhere along this new formed uptrend line. The thing has now broken out of its pattern, and it's continuing to move on. Everybody with me? Okay, now we're moving out of continuation patterns and into reversal patterns. Okay, a head and shoulders is a reversal pattern for an uptrend. So the first thing we need to have is a trend. Okay, so the question is do we have a series of higher lows? And the answer is yes. Okay, the buyers take it up, they sell it off and bring it back a little bit. Okay, they run it up exotically to the head. The sellers say no, 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 and they beat up on the tired buyers, drag it all the way back down to what we call the neckline, which is a minor support level. The buyers say, oh, we've got to try to take this up higher. They try one more time. They get exhausted, fail. Okay? As they break the neckline, then they start to sell off, and now the uptrend has been reversed. Now, there's a couple of features about the head and shoulders you should note. First off, generally the right shoulder will be slightly lower than the left shoulder. Okay? So if you were to look at the guy, he's standing like this a little bit. His right shoulder is a hair lower than his left shoulder. Okay? We're showing you one here on a horizontal. They can be on a slight angle. The neckline does not have to be flat. It could be at an angle a bit. All righty? The head and shoulders also describe a measuring object. And that measuring object is the neckline distance to the top of the head. And you can see it on this picture as described by a black arrow. Again, once we break down below the neckline, we could use that black arrow to describe our first logical target. Okay? It would be, that's how much we'd expect it to fall. And you can see that even after a retest of the neckline here, this is where it starts to find the little support for about 3-4 days right in here. Now, it does break down further, but again, if this is support, it could be bouncing back up. So this would be a logical projection, a nice goal to shoot for. Once we identified the left shoulder, the head, the right shoulder forming, now we're licking our chops going, where can we get short? The uptrend has got a clear reversal pattern in it. So, of course, it goes below. We get short right here. It brings us back up, and it stops us out. Because where would you put your stop? When you put a stop just a little bit above support? Yeah. So we see it on this day where it's breaking down, and we got short, and then the next day it stops us out. And then it goes up another day or two, and then it breaks down. We get short again. People, just because it doesn't work the first time, this is a game of probability. You got to give it several times. Are we allowed to take small losers in here? Sure, that's our job. Okay? Small losers, small winners, big winners. What we're not allowed to take is big losers. Okay? So that's all we have to protect against. So it gets short, we get short over in here, the thing comes back up and retests, we don't get a close above the line, we're still in, we're off to the races, okay? By the way, I would identify these as my pioneers right in here. As they drop down, I may take 50% of my profit off. If the thing is holding trend line real nice, I may just stay in it. But again, because of this distance from the neckline to the head, this is an area where I'd start to kind of, maybe it's time to pick up a few of the shekels. People, we put the money on the table. We put our hands over the table. Then we watch each other very, very carefully. He who grabs first grabs most. As long as it's on the table, you could grab my money, okay? But once I pick it up and I put it in my pocket, it's mine. So I have no problems at all measuring this distance, whatever it is, 10 bucks, gets down to 10 bucks. Take the profit off. Am I allowed to get short again? Sure. You can't go wrong taking a profit, people. You know, you're going, well, Mike, I don't want to spend another commission. Why not?
It's irrelevant.
Yeah, I mean, you're talking about $10 or 15 bucks, worst case, and you've got 100 shares on a $10 mover. I mean, that's no brainer. I'll spend $10 to make 1,000 anytime. Okay? So, questions on Head and Shoulders. Now, this one is really busy down here. Okay? This is an inverse Head and Shoulders, or a Head and Shoulders for a bottom. Again, this would be the trend reversal pattern for a downtrend. So we have to see a series of lower highs, and we do get them. Again, we see the left shoulder coming down here. This time it's the opposite group. The sellers are pushing it down as best they can. The buyers push it back up. The sellers sell it down to the bottom of the head exhaustively. They sold everything they can, and the buyers overcame them and bring it back up. There's a slight retracement, and then you can see how the bulls take over with these big stretchy green candles and run it up. Again, we have a measuring object. Now, note that the neckline in here is not horizontal. Okay, it is a little bit angled. Again, you can see that the left shoulder is deeper than the right shoulder. The distance from the neckline to the top of the head is our first measuring object. This one works out almost perfectly. Look what happens once it breaks above the neckline. It runs right up to that projected line, okay, and then falls off. Again, would this be a good area to take some profit? Sure. You know, maybe I go long 1,000 shares, okay, once it breaks the neckline. And what are we buying this thing at? We're buying this thing at $34.50. The thing runs up to $37 to $40, okay, and I sell 500 shares. So I made myself some really nice money. Now the thing starts to come back. Well, what if it retraces more than 38% of my breakout distance? I'm going to take the rest of my money off. Okay. So I didn't make a killing. I just made a real good, consistent trade. And that's what I'm here to do, people. That's what I'm here to do. Not to sit there and say, oh, well, I'm going to buy 2,000 shares before it breaks above the resistance line, and I'm going to get out everything up here. You don't know that. This is fun looking at it on a chart in hindsight, exactly. You ready? But at the time, you've got to deal with this candle, candle by candle, okay, at the hard right edge. And one of the things that we're going to do is work some hard right edge. Questions on the inverse Head and Shoulders? Now again, these are trend reversal patterns. Alrighty, now that we've looked a little bit about continuation patterns and the Head and Shoulders reversal and the cup and handle breakouts, okay, let's get into something a little bit more basic, okay. We've touched a little bit on volume. Volume, people, is the pressure. It's the steam that drives the locomotive down the tracks, okay. My mentor in Chicago was a guy named Sal Goldberg. And Sal, he said something to me that it's kind of a little poetic, but I really, really took it to heart. He said, remember, Mike, price is the lyric, volume is the music. What makes the lyrics work is the melody, the strength of the music, the underlying beat and everything else that comprises a song, okay? So volume is what drives a stock's price. It cannot go up without strong volume. It cannot go down without strong volume, okay? Now, price can drift down on low volume just due to apathy and the fact that what? Fear is always a little bit greater than greed. So if there's a lack of volume, price will slowly drift down a little bit because there's always somebody who's just a little bit more fearful than they are greedy, okay? If we're going to find any sort of a breakout or a significant move in the stock, we've got to see volume starting to build up. So this means we need to know a variety of things about it. We can't say much about a stock unless we know at least its average daily volume and how that thing works, okay? Now, we built a simple moving average the other day. And to get a moving average, we just took 10 prices, added them together, divided by 10, and that gave us our first data point. Now, we do the same thing with average daily volume. And it's a caution I'll point out to you guys in a second. But what if we were to take the last 20 days volume, add them together, divide them by 20, get our data point? On the 21st day, we do add another one. We take the newest one, drop off the old one, add them together, and we get a second data point. We now have a graph of our average daily volume, and we start to get a feel for where our stock is moving. Alrighty? Now, I want to make a caveat here. Guys, I still watch volume and add them up myself. But there's a lot of great websites out there. We went out to smartmoney.com. We had a look at that one, and it says ADV, our platform, provides us with some fundamental information. But you have to be careful because I do mine on a 20-day moving average, 1 month. The one at smartmoney.com does it over the course of 3 months, okay, 90 days. So, well, if Cisco is trading 54 million today, but it was only trading 36 60 days ago, their ADV is going to be much lower than what I know it to be recently. So if you're going to use a website to look up ADV, always use the same website so that you have a straight baseline. If you're going to change from website to get your information, then you better darn well know what their parameters are, because some may do it over the course of 36 months, some may do it over the course of 12 months, 3 months, or 1 month like I do, which is 20 trading days. Alrighty? So if you do it yourself, then you know what it is. But now ADV is a wonderful tool and all. Let me get another marker here. And we know that a stock cannot move without really strong volume, okay? But we don't know that it's strong volume until the close of the day. So one of the old trader tricks I want to show you guys here, let's say that our ADV was 10 million shares, and we've checked this out, and over the course of the last 20 days, the last 40 days, it's been 10 million. 9,998 and 10 million.1 and 10 million, and it's an average of 10 million. So what we want to know is that during the trading day, is this thing going to be 10 million or greater? Right? We don't care if it's less than 10 million. What if our stock at 10 million generally moves up $1? Well, if it only does 8 million, is it going to move the full dollar? Probably not, because volume is what drives price. Conversely, what if our stock today had great earnings and it did 20 million? Might it move $2 or more? Sure, it has a better probability of having more profitability in it. So one of the old traders' tricks is checking its pulse during the day. But here's where you have to be consistent and diligent, okay? So what I'm going to offer to you guys is first what we call, and you won't find this in books, the average morning volume. And perhaps you're going to take its pulse between 10 a.m. and 10:15 East Coast time. Ready? Now you have to do it at the same time every day. Ready? And I'm just going to be arbitrary. I'm not going to figure all this out. But let's just say this comes out to 500,000 for that 15 minutes. Now, if we do this consistently every day, do we start to build up a morning baseline? Yeah. Every day I see it's about 500,000, and every day it ends at 10 million. So I can say that 10 million is equal to the 500,000. So what am I looking for? Well, one day I get up and I check it at 10:15. I see I have a million on there. Instead of 500,000, I have 1 million. Well, wouldn't that kind of indicate that I might have 20 million at the end of the day? Sure, and I still have a lot of trading day left, so now I'm going to increase my share size, hopefully if I'm on the right side of the trade, okay, so I can take advantage of this extra horsepower that I've put in there. Now, why did I choose 10 to 10:15? Well, again, I don't want to be in that opening rush, that first 20 minutes, half an hour of the market day, because that's crazy time and it may give me bad information. I want to look for the market to settle down and show me good numbers every day. But there's no real reason why I can't make it 9:55 to 10:10. But I don't want to make it too late in the day. I want to have more trading time, so I don't want to start this thing at 10:30 and go to 10:45. I've already given up an hour and 15 minutes of trading time that way. So how about a shorter time? Nah, you need at least 15 minutes to get some real averaging of volume. You can't do this on a 1 minute or a 5 minute basis. But everybody starts to see how I build up a baseline here. Now I want to do this again in the afternoon. Remember, we have the doldrums where you probably will not be trading, or you'll be just watching and waiting for a specific opportunity. So the market quiets down. So maybe we need to throw in an average afternoon volume. And again, I might want to measure this from 2:15 to 2:30 East Coast time. And let's just, for the sake of discussion, say that that comes out to 300,000. So now if we start to build this up over time, we see that 10 million is equal to 500,000 in the morning, which is equal to 300,000 in the afternoon, which is equal to 10 million at the end of the day. So again, I can now go out, mow the lawn, come back in, take its temperature, and I see it's running 100,000 in my afternoon. Well, I'm going to go play golf, because there's not going to be very much horsepower left in the market to move my price. Or if I come back in from mowing the lawn and I see that it's 600,000, I know that something has happened during the lunchtime and that there's horsepower back into my stock again. Now, it's amazing how this is not pointed out in books and stuff, but we used to do this with just little spiral notebooks and a pencil. You guys remember pencils, don't you? They had a little sharp thing and a pink rubbery thing on the end, and you wrote that, yeah. And now you got computers. Anyhow.
So what would you do? Set this like a 15-minute bar at 2:15 and just or read the volume at 15 minutes?
Absolutely, absolutely. I mean, you know, how do you physically do it? Well, again, certainly, you just switch your chart to a 15-minute period and look at the volume. Put your cursor on. Let's do it. Let's just do it real fast on the platform. So here we just happen to have a Broadcom, and we're on a 1 minute chart. So let's switch this to 15 minutes. Okay, and here is our 10 o'clock. And guys, if you look at the very top up here, you can see that where my cursor goes, it tells me what time it is. If I move it over here, it's 10:15. So let's use the 10:15 one, okay, 10 to 10:15. And our volume is what? 213,518. We would then write that down and do that 20 more times each day. Okay? Well, Mike, I don't want to wait 20 days into the future. Well, could I go back 20 days and do this? Sure. Okay? Just put up 20 days worth and measure each one and write them all down at one time. And you get your average going. Okay? So you don't have to really work hard to get this done. Let's just see if there is a bit of an average here. Let's just go back 10 days. Okay, so if we go back 10 days, and here's the 10:15 candle up here, and the volume is 201,000. And then we go here to the 10:15, and it's 227,000. And we go to the 10:15, and it's 371,000. So far, it looks like we're at, what, about 275,000 average for those three? And then we find the 1015, and it's 300,000. And we find the 1015, and it's 348,000. And we find the 1015 is 161,000. Whoa. I guess we have to really add these up and start dividing. I thought they'd be a little bit more consistent in this, but this is how you do it, guys. And here is the 1015 is 209,000. And there's the 1015, 212,000. And yesterday was 264,000. And today was what? 1015. Come on, one more. There we go. 213,000. So I would say it looks like around 275,000 over 10 days. Now, I don't know if that's real accurate. I'm just kind of feeling them in my head. But that's how you would do it, guys. Now, what do? Well, you put it on an Excel spreadsheet, okay, and ask it to sum and divide by 20, or by 10 in this case. Now, if we start to see this going on, we get our intraday volume at key times, we know that if things are starting to pick up, okay, that we can now start to anticipate the breakthrough of a trend line or a resistance line or a support line, okay? And this will be very profitable to you guys because it starts to lay out your plan for you. Again, what if I were to get up and I check my morning volume and it's at 250,000? Well, again, it's go back to bed, okay? Because it's going to be a boring day. There's not enough horsepower to move price around, or go look at a different stock in my repertoire, okay? But again, we're looking for multiples because it takes volume to drive price. Now, here's an example, okay? Here we have a daily chart. And you can see that volume doesn't work bar to bar, but you can certainly see over here on the left-hand side how we have a real nice staircase of volume going up, okay? And that's what's causing price to move up. When volume starts to drop off here in August, notice how price goes sideways. It doesn't necessarily go down, okay? Again, when volume starts to staircase at the end of, or the middle of August there, you can see where price really takes off. As volume falls off, price goes sideways. It looks like it's going down, but it's not going lower than that previous bar. It's really just consolidating sideways, alrighty? And so on and so on and so on, alrighty? Now this one doesn't particularly show any major downdrafts. Let's take a look at another one. Again, we don't really see much here. We see volume dropping off over the course of these days, and price is drifting down. But guys, can you see right in here on the, what is that, it looks like about the 20th through the 26th, we have 1, 2, 3, 4 increasing. That's what's causing price to really sell off right in here. When the volume, even though it's green, starts to go down, that's where we start to go sideways again. As the volume starts to come back up, we see price starting to move back up. As volume drops off in here on the next month, we see price going sideways again. It's very important that you start to see this relationship. Now, we also get specific signals, okay, and these are called climactic volume changes. And generally, they'll be associated with a major trend change. Here we see over the course of several weeks, okay, prices moving up, and then it shoots away, alrighty, and we get a great big bar of volume down here. Well, again, this is the exhaustive run-up of the buyers and the takeover by the sellers. So if we had an uptrend, what does that tell you? Well, we could start to look for a downtrend to ensue, that uptrend, it's over. So if I were long in this stock and I got a really nice gap up like that, I'm out in the next period or two because I saw this. Now, even this guy over here on the right-hand side, this green one, if you notice, is probably 2 times as big as the average of the ones immediately to its left. Now, it's not as huge as this one, but again, you can see the 5-10 day sell-off here, and we get this guy telling us that this little downturn is over. So this too is a climactic volume bar. It's not as climactic, that's all. Alrighty, and we get a little bit of a run-up from there. And here's a couple more climactics, okay? Now certainly as we get into candlesticks, we'll also see some other things in patterns and shapes. This here, of course, is a shooting evening star up here, and certainly fairly bearish. But you can see how the bulls ran it up on increasing volume. We had a day where they had very little trading. Maybe it was a holiday or something, okay? The thing then gaps up and we get this very large volume spike, bigger than the previous bull run volume bar, okay? And boom, this uptrend is now over. The thing at best consolidates for the next several days, okay? Now, this one here really isn't all that climactic, certainly when you look at this bar and this one, but relative to its recent neighborhood, okay, it is a little bit higher than normal. And you have to start thinking about what averages are. Some of the charting platforms allow you to put an average line in here, which is very, very helpful. But you can see that we have these high guys right here, but we also have some very low guys in here. So the average is down in here, below that dotted line. So this one is almost twice as big as the average of the recent days. Again, we see a major sell-off, okay? And boom, that sell-off is halted by this climactic bar of volume. Questions so far? Once again, more of the same here, pretty much. Another climactic volume signal. Again, you guys can see off and on in here. Even though the volume is really low, you can see on the hard left over here that we staircase up for 4 days, causing this little bit of a takeoff, alrighty? As soon as volume starts to drop down, we start to see a lot of what we call spinning tops and dojis, where the market is kind of, it's still going up in price, okay? But that's kind of some momentum. There must have been something very exciting happening in this, alrighty? For that price to continue to go up on this lower volume, alrighty? Now we can see here, great big guy shot down here, down shot. Here's your increasing red volume causing the sell-off in here, and the climactic. It goes up, but does it continue to go up? Did it get a trend reversal? Well, yeah, for a couple of days, but it's really doing what? Going sideways, it's consolidating. Again, guys, what you want to look at here is seeing that somebody always seems to know something ahead of you. You can see how low the volume was on average, but in this last day, you can see that it was 2 to 3 times the last couple days in here. This is information leakage. Somebody is getting out, a fund manager, an institution, one of the market makers, and they're starting to sell it off. You can see the red volume plus graphs in here, but price really isn't reacting much. And then overnight, the news comes out, and obviously it was bad news. And Joe now has put in what? A tremendous amount of market orders to sell. Now, who is he selling to? Everybody's selling. Well, that's an impossible statement. Everybody can't sell, okay? You got to buy, it has to have a buyer, okay? So who's the buyer? Probably the professional trader. And this is something that's very, very interesting and kind of proves the earlier point. Even though the volume is so stark on this first one, and we do get that drop off, as you can see, the volume staircases down. What does price do? It just goes flat. And it starts going from selling in 4 bars to buying. Who's stepping in and buying it back?
Yeah.
Very good. The guys that got out over here, okay, the day before. They have now got it to an undervalued situation either by hook or by crook, okay? So now this is probably the actual institutions stepping in to buy it back that were actually trying to sneak it out the door yesterday. You ready? So you'll start to see these patterns. And one of the things we're going to look for is yesterday seeing a really large spike just before the close. This will also be a very good key that something is going to happen big time tomorrow. Again, here's just some more quick examples. You can see that as price oscillates up and down over here, there's nothing really remarkable about it, and therefore price just kind of goes sideways. As it starts to staircase up, we start to see gaps up. As the volume falls off, price goes sideways. As the volume starts to come back up, these couple days or couple of minutes, what are we on, 15 minutes? These 15-minute periods are what is going to give rise to the great news the next day, okay? So again, what we want to look for is some information in here that why is it coming down, and right at the end, there's a great big. It could be just simple anticipation of an earnings announcement. It could be insiders knowing something somebody else doesn't, okay? The only reason, by the way, I want you to guys always remember this, on volume plus, even though this bar down here is red and represents distribution, look at the candle that it is on. The candle opened up here, went all the way to the bottom of that shadow, and then the buyers had enough pressure to bring it back up and close it much higher. Okay, so even though it's a red candle and it's supposed to be distribution, was there not some buying pressure in that bottom tail? Yeah. So, and then what do we see the next day? Big buying. Okay, we've talked about this, about the PMI, the NASDAQ pre-market indicator, and I'll take you back out to the website and we'll do a little bit more investigation of it. But as I was noting to you guys yesterday, that the pre-market indicator is actually a more accurate indication of how much the market's going to gap up or gap down than the S&P futures are based on the last 4 or 5 years. Now, again, guys, when we have the futures up 3 and the PMI up 3.2, who cares, okay? But if we start seeing the futures up 15 or 20 and the PMI up 18, I'm going to defer to the pre-market indicator because I know through observation that it has been more accurate. And you guys can A, trust me, which I don't expect you to do, or B, start watching it and comparing it so you know it in your hearts that which one is better for you to look at. Let's take a minute and we'll go out to NASDAQ.com and just search around quickly and look at a couple of things on here because it's very, very interesting piece of work. Okay, guys, first off, let's minimize this stuff here and go out to our website. And last time we looked up NASDAQtrader.com and we were going to investigate the hammer. This time we're going to go out to NASDAQ.com and oh, there it is right on the top list, very good. And we're going to look at a couple of different things. Now, as with all the sites that we take you to, these guys, you need to go out and search around them for a while. You need to have a look at them. You need to spend an hour just clicking around because there's a lot of good stuff going out here. Now, right in the center, can everybody see here there's a little graph that says NASDAQ, and that's, of course, during the day. But if we were to look down below, we see a list of things for the Dow, the S&P 500, NASDAQ 100, and there's the NASDAQ 100 PMI. Does everybody see where my cursor is? So if I click on that, this is the pre-market indicator. And as you guys can see, yesterday, this is the horizontal line, this flat line down here, which is basically 1538 even, okay? And in the hour and a half from 8 o'clock to 9:30, prior to normal market hours, can everybody see that they're buying a little bit in here, that they are starting to get a little bit excited, and then just before 8:45 or so, it started to jump up more, and at about 9:15 we see that big spike and kind of levels out. So here's where we're going to start to see a little bit of indication of what the gap pressure might look like. Now, right below that is the after hours, okay? So we could look at that, and that would be yesterday's after hours. Give it a second to load up here. And here you see that horizontal line, and can you see that the thing really sold off, okay? So when we came to the pre-market this morning, we were very astonished that sentiment had turned so dramatically. Everything was below the line, now everything is above the line. So overnight there was a valuation shift. Now let's look into this in a little bit more depth. If you guys come over here to the left-hand side, you'll see extended trading, and there's the pre-market indicator. Let's just have a look at the different stocks that are in there. And again, here's that same little, almost looks like a submarine or a sailing ship or something out there, that graph we were looking at. But right below it are all the different stocks in the NASDAQ 100 that had some opening, gap up pressure or down pressure, as you can see by percentage. And they're listed alphabetically. So you guys can see right here that Adobe at the top had about 0.61% in it of uplifting pressure. On the other hand, that's not very significant. How about down here? We have Bed Bath & Beyond had about a 0.48% negative. It was likely to gap down, okay? And of course, we could scroll down through the entire NASDAQ 100. We can find out about just about anybody. Here's one of our old favorites, Clack, over here. If I put my cursor on there, note that we start to see things like the info, a summary quote, news, charting. There's our extended traders or even company financials. Well, let's go back to extended trading here and see what we can spot. Now, what this will give us is the actual trades prior to the market opening. Remember, we're in pre-market indication. Oh, excuse me, I guess we clicked on the wrong one. We're in after hours here. See where it says after hours? And this is 5:44 in the afternoon. And look at this, guys. Do you see where it's 50.44, 50.44, and then suddenly on 150 shares, it jumps 10 cents. Okay? And then 200 shares later, it drops back down to 43. This isn't even really exotic, but it should give you an idea of what can happen. 100 shares should not be able to change the valuation of a major company like KLA Telecom or like Cisco, but it happens all the time. Now let's see, where did we go wrong on this thing? We ended up in the after hours. We kind of wanted to look at prior hours. But there's other things that we can do in here. Let's go back to extended trading. Now here's pre-market quotes. Okay, so here's Clay Telecom just before the opening. Here's 9:29. Now we can page back all the way to 8 o'clock. Here we see a little, again, some dime jumps right off the bat. I didn't even notice. Look at that. 49.97 to 50.07 on a 400 share trade. Okay? And then drops 7 cents back down to $50 on another 100 share trade. Boy, you know, people, and this is just before the market opens. Extended hours are not the place you really want to be. Let's see, let's go back in here. I'll go back a picture or two. Let's go back one more here. Okay, here right now is the after hours most active. Let's take a quick look at this guy. And now, you can see here in this first or third column here, right next to the symbol, it says market closed. This is what the market closed at, alrighty? This is the last sale in there, and this is the differential since it's closed, and of course the after hours share value. Now, these guys are going to have decent volume. Why? Well, because they're the most active. So as we scroll up and down here, and we're looking at, I guess, the top 10 here, we see the good old cubes, Audible.com, Applied Materials, Intel, Microsoft, Cisco, Oracle. Pretty much the same old group, huh? Yeah, they're always there. And they all have some decent share size from several 100,000 up to 4 million, okay? But you'll notice that not only are we talking about NASDAQ, you guys see up here in the top left, we can do the same thing for both the Amex and New York. Let's click on New York and see what we find out. Okay, so here we see the most active, okay, and this is the most active share volume here, okay, share volume, and we see General Electric, Guidant, Lucent, Pfizer, Quest, but right below that is not only the most active, but also the most advanced, which may not necessarily be the same ones, okay, and we see Lyondell, Quest, Penn, Virginia, First Data, etc. And then, of course, here we even have the most declined. Would any of this give you some idea of what might happen with the stock tomorrow? If they're already trading it up, or already trading it down, or just vigorously trading it, can't you see that that may give you some clear indication of where we might see a gap? And of course, if the after hours was gapping it up, and just before the pre-market, the things started to go down, we know that if there was any sort of a gap up, that would probably be a very weak one, and we'd anticipate a lot of filling, and vice versa. So again, NASDAQ.com, okay? It's put out by the NASDAQ. It's got a ton of information out here for you, whether you want to look at sectors or a whole thing on the ETFs, the exchange traded funds, the pre-market and aftermarket that we've already looked at. Guys, you need to come out here, click around and become familiar with it. You don't have to read this stuff every day, but what if one of the stocks you were playing is in one of these most active or ready to gap up on the pre-market indicator the next day? Would that be good to know? You bet. Okay, so why do we look at the pre-market indicator? Well, because it's certainly going to give us very, very strong indication about gaps. And we know that the stocks routinely gap up and gap down, okay? Overnight, we have our opening gaps. Well, what does it make? Well, why do they gap up? Well, we already talked about that. It's just basically news of one kind or another, whether it's geopolitical events, sometimes it's geographic. How about a volcano? You think that might change something? Sure. Could be just earnings reports or basic sentiment. Alrighty. Gaps can be classified as opening gaps, common gaps, breakaways, runaways, and exhaustion gaps. We're going to take a look at a few of these. Again, as beginning traders, for the first 6 months, 9 months of your trading career, I don't think you should be playing gaps. But I want to explain how they are played so that as you become more sophisticated, you already have some background knowledge. Okay? Now, here's a series of common gaps, opening gaps, okay? As it says up here, they're least technically significant. There is an old adage that at some point all gaps are filled, okay? A lot of people were laughing about that in 1999, but guess what? By 2002, all those huge gaps up were filled. Okay? So, they don't always indicate price direction, okay? Certainly, they really occur strongly in illiquid markets. If you have stocks that are trading less than 1 million ADV, it's easy for a few 100,000 shares to cause a significant gap up or down, okay? Again, I really don't want you playing those kinds of stocks until you have a little bit more experience. Now, here's the breakaway gap, okay? A breakaway gap occurs after a trend pattern has been completed and the birth of a new trend has probably arrived, okay? What does it say up there? Has arrived. I said probably arrived. It identifies with a rapid change in sentiment and usually will occur with extremely high volume. It is usually the start of a major move in new direction and new price. Well, as we look up here, we can see that we had a very nice uptrend over the course of several weeks, okay? But look at the volume down here. It's so small you can hardly see it. So certainly, do we not have climactic volume here? Absolutely. And we have a huge gap up. What are we thinking? We thinking long or short? Long. Really? Okay. You've got a trend, okay, and then you have a change in volume and a huge gap away. Okay? I think things got to come down and fill. Now, it may not come all the way back down to here. Could we just go and apply some of our fib stuff on there?
Oh, sure.
What if it came down 38.2% and started going back up?
Strong.
Well, then Al would be right. It's time to go long. Okay? But what if it filled more than 61%?
Probably.
Definitely thinking about short now. Okay? So there's a lot of conditions. You just can't, I can't stand up here and say, oh, absolutely, go short. Okay?
We don't have enough information yet.
Well, you know, once again, in just our discussion of volume, we just looked at climactic change. And we did have an uptrend, so a change would be a downtrend. Okay? But you're right.
If
I mean,
the stock was strong, you wouldn't have so many sellers bailing out right at that point up there.
well, how do you know that they're sellers? I mean, that's not a great big red candle. I mean, there was selling and buying pressure on both sides, was there not?
Yes, but it seems that in the end, the bears.
Barely won. They
Right.
opened the stock here and they closed it here. They had it all the way down to here, but the buyers had it all the way up to there. Guys, look at some of the other candles in this stock. Look what their average size is. Remember, the larger the real body, the more control. So, yeah, it came out as a red bar only because it closed a few cents below its opening price. But this was almost a standoff, wasn't it? I mean, the only thing that was really notable about it was the volume, not the range. Okay, the real body is actually kind of small. I mean, Miles is absolutely right. The Bears won. I mean, they won the battle. But this is kind of like Braveheart, you know? You have all these crazy Englishmen and all these crazy Scotsmen with the blue faces, and 20,000 people fight. And at the end of it, there's Mel Gibson and his buddies standing there, just two of them, and he goes, "We won." You know, there's 20,000 bodies laying around. You go, okay. Somebody made the adage, war doesn't prove who's right, it proves who's left. Okay? Okay, now, here is a breakaway, okay, and some intraday behavior. And the first thing that we notice is that the gap does not fill. Alrighty? So, in this case, here's Al's comment. We had the breakaway on an uptrend. We had zip or no fill. Now, the thing didn't take off to the moon, but it certainly wasn't weak, was it? No. So we saw this. Are we going to go long? Well, maybe the next day. Let's let this thing rest. It's done a lot of work getting up here. Okay? So we still may be in an uptrend, but we haven't seen any weakness by virtue of gap filling pressure. Now, here's another breakaway, okay? Good, strong uptrend. The thing breaks up, and you can see, again, it opens here at the bottom of this green candle and goes up. The sellers had it all the way down to here, so that was the fill. Again, almost insignificant relative to the distance between the opening and the yesterday's close, okay? And because of that very light fill, we can see that we start to get a series of higher lows. And again, if we're going to draw an uptrend line, can we buy near support? Yeah. We'd be a little crazed just to start buying it right in here until we saw it break out above. Maybe we could draw a real steep one up through here and make a bunch of short trades. Remember, the steeper the angle on your line, the shorter the time you're going to be in the trade. But it would also keep us from doing what? Getting caught in a downturn like this. So a lot of little steep lines, make one trade, make two trades, make three trades, make four trades, make 5 trade fail, make 6 trade fail, stop trading. Something's changed. You had 4 winners, then you had 2 losers or 2 small losers. Things are changing, okay? The The technical levels are major news attracts a swarm of new buyers, okay, in an uptrend or sellers in a down. The momentum of buying or selling rapidly moves that price up. If the new trend is to be major, the gap should not be filled in the subsequent trading sessions, okay? So what are we expecting tomorrow? This thing to have a split opening or another gap up if this thing is going to continue up for any length of time. It's got to have another punch of horsepower there to keep it going up. If in the ensuing days the gap is filled, the breakaway is potentially much weaker than it appears right here. And boom, it comes back down. Now, here's a runaway gaps, okay? These are mini breakaways, if you will. They're also called continuation gaps, alrighty? They are a continuation of the trend. We see the first one right down here, and here's our breakaway, and then it does a couple of periods up, it breaks away again, and then it breaks away yet again. It consolidates, and we see a couple little more small ones in here. You ready? It occurs during an exponential advance in the middle of trends, up or down, okay? Typified by very fast prices and high emotions, alrighty? And again, you can see that in the big long stretch, in this case, bull candles in here. Okay, they have bottoming tails on them and they gap again. There's a little bit of rest period and then the bulls take over for another shot up. So you can see how people are just thrilled about that. Now, what has been our recent hot stocks? In the last couple of weeks, we've been seeing things like Taser, okay? Security stocks because of the Iraqi geopolitical situation, and they have candles like this, okay? It's fraught with human emotion, not with technical challenge, alrighty? And there's a big difference there. Now, ultimately, everything comes to an end, okay? We have exhaustion gaps. And this, of course, is the great question. How do you know when a breakaway, okay, or a continuation gap is an exhaustion gap? Good question, okay? Exhaustion gaps are the final gaps or gasps, if you will, in a sharp trend. In this case, a downtrend. Here, a breakaway gap is followed by an exhaustion gap. Notice how the gap was subsequently filled. So in this case, we're looking at this downtrend here. So we had this big run up, okay, a couple little continuation gaps in here, and then we had a breakaway to the downside, a couple of real stretchies, and then it gaps down again. This is the exhaustion gap. How do we know? Well, because by looking, we start to see that we get actually 100% fill. This thing is now starting to show some stabilization, consolidation, and strength. So if we were clever enough to see this and we got short and we start to see this, kids, it's time to probably buy cover. You ready? But Mike, 5 days, 6 days later, it went down further. Again, I can't look in hindsight, people. I have to live by a certain set of rules. If this gap is filled by greater than 61%, it's showing strength, and I'm short. Yeah. Okay? No. Better I do what? Get out and sell it short again. If it continues to go down and proves that it wasn't a trend reversal, that it was still going down, I'll sell it short again. Cost me another commission. Big deal. Okay, so here's the famous question. When is a runaway gap an exhaustion gap? Okay. Exhaustion gaps usually lead to imminent and substantial price reversals. So generally, if it is the exhaustion, we'll see it drop down in that last case and immediately come up. Alrighty? Immediately start to come back. Exhaustion gaps typically occur as the second or third gaps in a series of continuations. We talked just a little bit about Elliott wave the other day, okay? And I said Elliott wave theory goes up in 3 thrusts in 5 moves and down in 2, okay? Why did Elliott come up with 3 thrusts up in 5 moves? Well, once again, I can tell you from personal observation that one of my standard rules in swing trading is if I'm up 3 days in a row, the odds of me being up the 4th day are slim and none. Now, I can prove it. I have to get my records out. But people, I know this in my heart of hearts, okay, from just taking profits, and if I hold them too long, they erode. So I'm about the 3rd time I'm up, I'm pretty much sure it's going to take a big rest. So I'm not surprised to see this, that the exhaustion gap will typically occur as the 2nd, probably certainly the 3rd gap. Remember, that's going to be the 4th big move, is the 3rd gap. Alrighty? So now we certainly don't know it's an exhaustion gap at the very opening of the thing. We're still fired up, full of our, oh man, we've been gapping up here for the last couple of hours and we're making a lot of money. Okay, we might want to check our volume, see if it's becoming climactic, if it's getting really stretched out there. What else might be happening? Could we start to see if it's an uptrend, that the candle is coming back down, leaving an ever longer wick on top, a topping tail? And you go, yeah, take the money off the table. Okay, grab that money, put it in your pocket.
Wouldn't you have to expect, generally the first gap is the pro gap. The second gap is kind of the intermediate players getting in there. By the 3rd gap, that's the amateur gap.
That's a good way to put it. Everybody hear that? Miles said the first gap is the pro gap. The second gap is kind of the semi-pro gap, the guys who aren't quite getting their information as fast. And then the 3rd gap is poor old Joe coming to the party going, what's going on? And that's who they shear. You're the last one in, you get to pick up the tab. Okay, so that's not a bad way of looking at it. You ready? Okay, again, here's island reversals. Okay, island reversal is the result of an exhaustion gap. It usually occurs at the tip of a V formation, up or down. Okay, an exponential drop followed by a rapid rise, signifying the sellers were absolutely exhausted. And over here on the left-hand side, we see this thing gap down once, a little bit of a gap here, and then the big breakaway, the fill, okay, and then the change in trend. So this guy right here is kind of an island reversal pattern, this little island sitting by itself. It gapped down here, it gapped here, and it gapped up. This was telling us this is higher than, this guy has already filled, what, more than 100%. And they tried it one more time, and they just couldn't take it any lower. So after a sharp V bottom, an exhaustive try by the sellers, the buyers take over. Okay? Now, again, you're going to see this in the more illiquid stocks. You're not going to find this happening in an Intel or a Microsoft or a super cap. Okay? There's just too much dilution. I don't even know who.
Morris?
Oh, this is Philip Morris, and I'll bet you these are all news. Yeah, these are all cancer cases here. Okay? Before they change their names to Altria, the nice people. Okay, and again, we've already kind of discussed this, so I'll go through this quick. We've talked about upside gaps. How about downside opening gaps? Again, these just are talking about events that have occurred negatively in the stock overnight, okay? There is a difference, though. Downside opening gaps with very little fill, as we've already talked a little bit, give rise to about 70% of the time they'll have a close lower than their opening price. When we talked about upside gaps the other day on the board, I said, if we have an upside gap, it only fills 38.2, it's kind of strong, but it'll fill about 60% higher than its opening price. Again, the difference between 60 up and 70 down is the difference between fear and greed. Okay? And so if the thing's got bad news, it tends to really, it's at least 10% worse than good news. I think I gave you guys this one already, but I'll remind you again. Remember, Good news lasts from 1 hour to 1 day. Bad news lasts from 3 hours to 3 days. Again, because fear is the greater of the two emotions. Now, trading the gaps, okay? Well, we have first the fade. And the opening gap fade is going the opposite direction of the gap, okay? That's what they mean by fading the gap. After the opening gap, the market usually will wholly or partially fill the gap. Taking a position in the opposite direction of the gap is called fading the gap. If the gap is not filled in the first 15 to 45 minutes, okay, it is a strong indicator that the market will accelerate in the direction of the gap and close considerably away from its opening. Now again, we've already talked about this, but I'll put it up here on the board. If we're talking about a gap up, we know the stock closed over here on yesterday and it gaps up. Now, the initial fade the gap would be to do what? Go short. You see the gap up and you figure, anticipating that there's going to be some, if not all, gap fill, we would then sell short within the first 15, 20 minutes of the opening. Again, you want to let the craziness get out, okay? And then our clues would be by the amount of fill that we got. So if the thing only filled 38%, 0.2, and started moving back up, then we would get out and buy cover. If the thing continued to go down to the 50%, we might want to just pick up 50% of our profit and hang on to see if there's further weakness. If it goes down to 61.2% of the gap fill, or 61.8, excuse me, of the gap fill, we might actually even want to add to our short position, anticipating that it would even go lower. Make sense? So 38 or 2 or less is going to be strong. 50 is, we don't know, it's a question mark. 61.8 or greater is going to be kind of weak. All right, so we might actually want to add to our position. Now, if the thing does not fill, and this is why we don't recommend you guys play gaps right off the bat, because you get a little bit eager. You see this great big profitability in here, and you immediately go short, and the thing does this. Because after all, it has great news in it. That's what causes the gap up. So I don't want you guys gambling. Remember, there's only one coin in the market. One side is reward, one side is risk. You can't have more reward without accepting more risk. Wow, Mike, I want to make a lot of money on this big gap. You're looking for a lot of reward, but the risk is it does this because it has good news. Okay, the bigger the gap, the more reward, but also the higher the risk.
Well, generally, the opening, if you have good news, you're going to get all those orders that are on the desks initially that need to be filled, that's going to push the stock up for that 10 minutes until those orders are filled. Then the professional will come in and just take his money right off the table and bring it right down.
Absolutely. We get right back to the key times of the day again. Okay, if there's a lot of market orders to buy, the market makers are going to fill them as fast as they can, and then they're going to try to bring the price down for a number of reasons, whether it's to cover their shorts or buy inventory at a lower level or whatever. They're going to try to force this down. So, but this is the gamble. Do we sell short and bet that the market makers are going to manipulate it down? Or are we going to sell short and hope that the news isn't as strong and it's going to go down? Or are we going to sell short and have a real tight stop here, and if it doesn't get any kind of fill in the first 15, 20 minutes, we're just done with this trade? And that's obviously, the last one is obviously the correct answer. And again, I don't want you guys trading gap fades for the first 6 months. This is a high, not a high probability, it's a high gamble that you're going to be right. But I want you to know about it because you won't be here in a year. Okay, so I'm going to tell you about it now, but put this one on the back burner and watch it for a while, and then you start deciding how many times does it gap up and fill, And how many times doesn't it? Okay. Now, we've already talked about this, but I'll go back through it real fast. We kind of did this tongue-in-cheek. This was Spencer Sheldon's gap reaction barometer, okay? And here we have a gap up. The prior close was 72. The thing has opened up at 75. So if we get a fill to about 38.2 or less, then it's technically kind of strong, okay? If we get a fill to 50%, then we say it's so-so. Alrighty? We don't know where it's going. We need to wait for more information. If it goes beyond, down to the 61.8, okay, then it's kind of weak. And of course, if we got 100% or greater, then it's very weak. Or if we got 100% or stronger, it's very strong. Alrighty? Where did we get these? Well, again, we're going to talk about it at a great length in the Fibonacci section. But that's where we got these guys. Basically, we're talking about the 38.2, the 50%, okay, and the 61.8%, okay. Now, what about these other ones up in here and here? Oh, there's other fib levels that we will get into, and we'll look at the 23.6 and even the 127.2 and stuff like that. But we'll get more into Fibonacci later. Now, here's some classic fades, okay? We can see we see the opening gap, a big gap up here. And what we want to do is wait for some time to see if that gap is going to fill. Now, there's a lot of people who would see this large gap and short immediately. And you can see what happened to them. They had to have the patience of Job and the strength of Hercules to endure, a buck and a half move against them, okay? So we want to, once again, we want to give it at least 10, 20 minutes in here, let this craziness get out, already? And in this particular one, what we're saying is, well, why don't we wait till it breaks through the opening pressure? Here's where the opening was, right here. So let's get short once it breaks, and that's somewhere around 10:30 or so, okay? The thing continues down. It finds support right at the 38.2. Now, what are we on here? We're on a 5-minute. So we find support for about 15, 20 minutes in there before it breaks down further. Now, we don't get quite 100% fill, okay? But then we start to see a staircase of higher lows. Once it moved back above the 61.8, I'm pretty much done for the day on this trade, okay? I was real lucky I got in here. Maybe I took some profit off, took a little extra profit, and got out the rest here, okay? As it proved to me I was wrong. It's no longer going down. After all, it gapped up. After all, what's the trend going to be for the day? It's got some good news in it, all righty? So we can use Fibonacci or yesterday's price and resistance levels to determine support for our profit objective. The first one, we can see that I was talking about the fibs, where it sat on the 38.2, where it finally broke down to the 61.8 and came back up. But I could also use this support line right in here from yesterday's close, or the high of yesterday, okay? These might be, but Mike, why would I get out here? It went lower. You can see that now. That's all I can answer that. So we could do it a couple different ways of looking at this. Now, this one's a lot more complex because we can look at it from a variety of different ways, okay? Now, here's trading the gap, already? Now, if we fade at the gap, that means we're going opposite the gap. If we're going to trade the gap, that means we're going with the gap, okay? So we can see yesterday's close way down here, okay? The thing gaps up and moves up strongly and then retraces. Again, I could probably throw a Fibonacci from down here to the high up here and see that the thing does not fill in the first hour more than about 38%. But it does break down further. How far does it break down? Well, if we took yesterday's lower highs as a downtrend, isn't it amazing That's right where these guys start to find support. In fact, if you look at this purple magenta line in here, you'll notice that this high connected to this one is basically the opening price. Okay? When it came down, it sat for a period of time right on yesterday's high. Once it broke down through there, where did it go? Back down to that magenta line and then started trending up. If we give it a few minutes, okay, I forgot the orange line down here too. If we go back and we spot where we have some support, and look at that, the shadow comes down and touches that peak right there, bing, bing, and bing on the next day, okay? We then start to see a few higher lows, okay, and perhaps we start playing connected dot this way. And sure enough, for virtually the rest of the day, this thing cycles right off of that with a little bit of a problem right around 330. Why? Well, again, they bought it long and they're going to take some profit out, so it's going to finally break our upward trend line and we're out for the day. So now the first one was fading the gap, where we were looking to go short and taking advantage of the gap fill. Now we're talking about how could we play it as trading the gap and looking for support in here for an uptrend based on the good news. It's just the way you look at it, people. Some people are contrarian, some people go with the flow. Questions so far? Good. Okay, now here's the exact thing. Instead of doing it with support and resistances, we're doing it with Fibonacci, okay? Again, here's yesterday's close on the red candle, the bottom of the red, to the top of the opening. Here we see the price go up and it comes all the way back down. It sits on the 23.6 line. Now, admittedly, this guy does go through the 38.2, but you can see it bounces right back up and sits primarily on this 23.6, showing some fair strength. Again, we would have to wait a couple of hours to get long in here, okay? Where would I buy long? Well, conservatively, I'd wait for it to come above the opening price, so I'd be buying somewhere right in here. But I would already have an uptrend line drawn in there to help me monitor this trade. Okay? Again, we might say the thing came down all the way down to here. Maybe we could buy it a little bit off of support right in here and hope for a breakout above. We're just a little bit more aggressive, that's all. Okay? Questions on this? Now, again, I'm showing you an awful lot of Fibonacci, and we really haven't had the full lecture on it. So I don't want to, I'm hoping you understand that I'll show you where we get these percentages and all later. But we do refer to them often enough that, I don't know, maybe the first thing we should teach in this class is Fibonacci. Okay, and we're just adding in that circle. Okay, so here's a different stock, okay, and again, we're going with the gap, we're trading the gap, so we're looking to figure out which way it's going to go, alrighty? This is a tough one, alrighty? We have a kind of a consolidating stock from yesterday. We can see that overall it was a downtrend, but you can see with this magenta line coming down, we have actually two descending triangles here. We have this purple and blue one from yesterday and the purple and blue one from the lows of yesterday. So this would indicate to us what? That we'd actually be expecting a breakdown, wouldn't it? Okay. And sure enough, what happens? It fools us again and breaks up. Okay. Thing then comes back down. Where does it start to sit? Okay. Well, we find that it was on the last highs of yesterday. We find a little bit of a support line in here, okay? We can see where it's coming down and it keeps touching these other lines that we drew yesterday, okay, have become somewhat significant. But this is a tough trade because what am I going to do? Buy near support, okay, and I'm going to get out where? Near resistance. Well, where's resistance? How about the high yesterday, just a little above the 49.60 in here? That wouldn't be a bad goal. Buy near support, sell near resistance, buy near support, sell near resistance, buy near support. Small loser. Okay? Well, guys, if I wanted to show you perfect trades, if I wanted to show you how easy it was, that's what you would think. It's not. You know, I could throw Fibonacci up in here and it would be just as difficult. You ready? This is a tough day. Okay, it's just a tough day. That's what we call chop. All right? The next portion, we've been talking about gaps. What happens when they do not gap? Well, these are called split openings, and there is a proper way to play them. Okay? What does it say up here? Rarely do markets open without a gap. When they do, they're called split openings. The previous day close and opening are approximately the same price. Now, what is approximately? Guys, pretty much, 10 cents or less. There may be an actual gap, but for all practical purposes, there's not a dollar. Alrighty? This is exemplified by this stock on 9:30 and 10:1. It's in its opening price range. So here we can see the stock closed on this red candle right here, and it opened on the spinning top right next to it. So it was effectively a split opening. How would we anticipate what this thing is going to do? Well, let's give you a little bit of methodology. Okay, so the first thing we want to do is look at yesterday and identify the direction that the market breaks in. So yesterday we had a downtrend, and today we had a split opening, but the market did immediately what? Sold off, right? So we had a little down pressure, and it broke to the downside. So then we go to number 2. The market will then travel to the nearest level of support or resistance. Well, we're going down, so it's going to travel to the nearest level of support. What's the nearest level of support? How about yesterday's lows? Okay, so we draw that line in there. And you can see that it stops right there. Yeah, half an hour later it pops it a little bit. But you can see how it comes right down to that support line and bounces back up. The next thing we do is then look for a reversal through the opening price to the opposite level of support and resistance. So we break this here and it starts to move up, and we then see it move directly up to this little resistance line created yesterday by this series of tops right here, which also happens to be what? $21, a nice round number, a natural support or resistance line, okay? The price consolidates for a little bit, alrighty, and do you guys see a little symmetrical triangle in here, or maybe a bull pennant, okay, which would be bullish, alrighty? So then we do go to number 4. We look for a new trend to develop from these initial support and resistance levels. So once we break out, we can certainly buy it again above the 21.05. We eventually put on a trend line and put a rule on, and we're off to the races. The split opening. Okay, so even though this thing has been in kind of a downtrend, the split opening told us at the beginning it breaks in the opposite direction that it's ultimately going to move. Okay, so had that thing broken up, we'd be looking for a short for the day. As it broke down, we're looking for an up for a day, but it has to meet certain criteria. It's got to cross the opening price, it's got to hit the other support and break it, okay, or resistance in this case. Okay, we also have key reversal days. And again, these are, the reasons I'm talking about these things is I want you to be able to spot when trends start to change. It's very easy to buy in or sell short into a trend and say, oh, it's never going to end. The real trick is to see the train coming, okay? And that's what we're talking about here. Okay, what is a key reversal? Well, a key reversal day occurs after a long rise or decline. It is the pivotal point that indicates the end of the move. In an uptrend, it is indicated when the price opens above the prior high, yet closes below the prior day's low. Okay? In other words, there's a significant reversal intraday. In a downtrend, it's just the opposite. We expect it to go down lower, but it closes higher. Key reversal days are associated with substantial increase in volume. Would our average morning volume help us here?
Oh, yeah.
Absolutely, okay. They represent an exhaustion of either buying power or selling pressure. Now, this is a pretty good shot here. The top one, the same stock, it's the Dow Jones on a key reversal day, but you can see it intraday, and you can see how we had this really downtrend for several days, a couple of weeks actually, okay? And here is where it opened. It traded down to the midday, key reversed, and closed all the way up here. You ready? And here's what it looks like on a daily candle. Okay, we can see that the red's coming down, already, and the thing opens down here, and then it traded all the way down. But by the end of the period, the buyers brought it up through the opening and closed significantly higher than its opening price. Okay? Again, you're in this thing short, and the thing starts to make higher highs. Is my downtrend line broken?
Oh, yeah.
Sure. So there's a lot of different ways to look at this, people. I'm just trying to give you some different thoughts. Again, if I were holding this thing short for several days, I may not get out until the 13th after I see the key reversal day. But I know that my overall downtrend is over, at least for a while. Okay, nothing lasts forever, people. So whether I'm working this on a 5-minute basis or whether I'm working it over the next 5 days or the next 5 weeks, you've got to pay attention to these different indicators. Because like I say, the most important thing when you're crossing the street is to look both ways. You know, if you're only looking to the right, the bus is going to hit you from the left, ready?